So at this point, I would invite everybody to sit back and relax as Jamie's part of the presentation begins. He's going to be the majority this afternoon. Jaime Carrasco is a portfolio manager with Canaccord Genuity Corp. And Jamie is a Canadian investment professional with 25 years of experience providing wealth management and investment counsel to affluent families, businesses, and institutions both in Canada and Latin America. And today, Jamie will be presenting in his field of expertise, which is precious metals and Bitcoin. And I know we're all quite excited to hear about that. So without further ado, Jamie, I will hand things over to you and you can start the presentation.
Start my video. Thank you for having me. Thank you for this opportunity to speak. Now, I think I should change that chart because I've been in the business for 31 years now. And oddly enough, one of the things that is quite interesting about having been for 31 years is that I was young enough to have been mentored by bond traders, because I used to be a bond trader with Gordon Capital early on in my years in the industry. And they were the last generation of bond traders to have worked under a gold standard. So one of the issues that I think we have today is that most of us and the people that are younger than me in the industry have never really lived in a monetary system based in gold, but I was taught to think in terms of bonds or fixed income with gold in the background as the base of a monetary system, which allows me to see things a little bit different. Now, one of the other things that I like is I love history. I study political science and economics, and I love history. I speak 4 languages, so I look at the big picture, the big puzzles. And the reason for the title of my presentation, Surfing Mavericks, is because the way I see the gold trade is you have to understand the forces that are coming together. Mavericks is, there's a wave called Maverick. It's one of the world's top 10 big waves. Those big wave surfers surf them, but they don't occur all the time. In order for them to occur, everything has to be right. All of the forces have to come together, and when they hit, they create these massive waves that these guys can hit. The gold trade, to some extent, is setting up to be the same thing, because I think from a historical basis, we're setting up the economic, the geopolitical, the monetary forces are coming together to create what I think will be an amazing wave that, in my opinion, has already started to build. So the way that I look at the trade is to look at trying to surf or participate in what I think is going to be, in my point of view, the best trade of my career. If we can move on to the first chart, what I wanted to show you guys first of all is that the trade is working. Most people have not currently seen this. There isn't any participation coming into the sector. If we look at asset allocation or participation in the sector, has been very anemic until now. We're starting to see some money working. But what I want to show you is this, is that I started tracking this. Actually, the portfolio that I'm going to refer to that I manage, which is a segregated portfolio, was set up in 2015. And we'll go back to that later. I'm going to try to do this a little bit backwards. But the portfolio was set up in 2015, but this is from 2018. I started tracking this from October 1, 2018, because that was the point of time at which the Fed started to try to lower rates. I thought that from a fixed income perspective, that was going to be critical, because it was, in my opinion, at the time, a speculation that as the Fed starts to drop interest rates, they're going to lose control of this behemoth that they've created, that I think as we go forward, they will lose control. Now, if you go back to the fall of 2018, no, don't change the chart yet. If we go back to the fall of 2018, and can you guys see my mouse moving, Jordan? If you go back here to October 1 of 2018, the Fed had already started to lower rates, to raise rates was already in a rate rising cycle. And from the fall of 2018 to January of 2019, the market had a bit of a hiccup, forcing the Fed to reverse rates. And that's when we saw the Dow start to move again until now when we've had this decline. Well, since that period, gold started appreciating. Actually, gold hit bottom in December of 2015. I set up the portfolio in 2015, anticipating that point when we got down to $1,000 gold. By this point, it was trying to break above 1,300. And then we know what happened. However, again, another point that I want to make with this chart is that the producer started to move at that point, and since 2018, the numbers, the Dow is negative. So had you invested $1 in the Dow, $1 in gold, and $1 in the HUI, which is the sector index for the precious metals, you would be up 110% as of last Friday with the precious metals, with the precious metal sector, 46% with gold, and down still 11% with the Dow. Okay, let's move over to the next chart. One of the things I want to point out as well is that this wave is just starting to build, and there's a lot of forces coming. Even though the sector itself is up 110%, one of the things that I want to point out as well is that the sector is moving, is just starting to catch up. If we look at the gold stocks, I'm still very optimistic with the gold stocks, because the HUI, which is the blue line here, and this chart is comparing gold and the HUI all the way back to 2011 when we had that massive decline in the price of gold. Now, just for reference, this point up here is when gold hit up to 1900. This sideways movement to me back in 2011, because I started playing gold in 2006 because of the interest rate cycle. To me, it was a normal sideways move. This is the surprise, the decline that comes starting around 2013, because this, you will see, is also part of the forces that are unleashing now. One of the mantras for the gold trade for the longest time that I've been saying is that the longer it takes, the bigger the fiscal mess, the higher gold will go when it finally unleashes. Well, one of the things here is that I'm trying to point out is that the HUI and gold had stayed very correlated until about 2015, when gold finally took off. But the sector index hasn't yet. Now, this is the catch-up that it's just beginning, in that the HUI just is sitting at around 300, but it should get up to about 550 to catch up to gold at 15 to 1600. Now gold, it's at 1750. So the companies are moving higher. One thing that I would like to point out about this is the fact that gold is actually doing what it's done for 4,000 years, which is to rise with systemic risk. The earnings of the companies are also rising right along with systemic risk, and that is what really driving the trade. Can we go to the next chart? Another benefit as well of the sector, and why I'm not just playing the gold companies, is because silver is also has been lagging, and it's finally starting to move. Silver, within the portfolio, I also have silver companies, because I think silver will be exponentially faster than gold moving forward, and same thing with the companies. Silver right now is sitting at about $17. One of the measures for silver is the gold to silver ratio, which, if you go back to the Roman times, it has always stood at about 25 to 30 to 1 to gold. Well, down here, just back in February, it was trading at 110 silver to gold. Let me back up. One of the important things about that gold silver ratio from a historical perspective is the fact that we pull out about 25 to 30 ounces of silver out of the ground for every 1 ounce of gold. It's part of its scarcity. And actually, if you look at the Roman times, one gold denarius was worth 25 silver coins at the time during the Roman monetary system, which was fully gold backed. So that balance or that ratio has stood the test of time. And one of the speculations that I'm betting is that this will not be any different, and silver will catch up. Usually they consider silver poor man's gold, because what happens is that when people finally get it, they can't afford gold, so they go out and buy silver. I think silver, I'm very excited about my silver companies, because now we're starting to play catch up. And I think from that perspective, there's quite a bit of wave surfing to be done going forward as this wave builds. I also think that the price of gold has much to go, and I will show you why, because gold as money. I don't see gold as an investment, by the way. I see it as the ultimate form of money. As JP Morgan said, gold is money, everything else is credit. And so because of that, gold is a constant that throughout history is once again, in my opinion, it's not different this time. It will be used to cleanse the system of its debts. So again, it's the connection of the monetary system that is what's driving my speculation into this sector, in that how we're going to deal with all these debts. Jordan, can you shift? Okay. Let's go back on history, because the 1930s, I don't know if you guys have followed Ray Dalio and Gunlash. A lot of the bond guys are coming back and saying the 30s are repeating. This is something that I've continually been saying since 2015, when I started really talking about gold on BNN, because in my opinion, if you look at history, the fundamental forces, again, think of Maverick, those forces that are building to drive the trade, is all about debt. The parallels to the 30s are very important. First of all, the populist wave, the social issues. Everything's being driven by the fact that from a debt perspective, just like in the 30s, we are hitting the ultimate utility of debt. So think about the 30s for a second. Coming off of the First World War, we were at a point in time when debts were not, any further amount of debt wasn't creating any economic activity. So the world became, the global growth was stagnant by 1930, okay? One of the issues with that, if you compare the parables, think about today. Today we have hit maximum utility of debt. So one of the issues that we have is that any further debt is not going to generate any growth. The central bankers know this, right? And the reason being is that when you start, the issue with that is, think of a bell curve. The more debt that we put out into the system, the growth utility of that debt starts to decline when it gets to zero. So by the year 2000, $1 of new government debt was generating something like $5 worth of growth. By 2008, we weren't generating more than $2 worth of growth. That's why, if you look at economic growth from 2008 to today, it has averaged about 1.5% to 2%. Right? Just lately have we been able to hit 3, but before the COVID-19 thing, but that was because of the amount of money that's being printed. So what happened in 1930 was that in order to reset the debt system, Roosevelt transfers the currency reserve from the British pound to the dollar by creating a brand new dollar backed by gold. And in order to do that, gold rises from $7 to $35. Think of it in terms of a balance sheet equation, where if you look at debts and liabilities, right? And then think about gold as a monetary base. In 1933, there was 27,000 tons of physical gold circulating between all central banks. Of those 27,000 tons, the US had 8,900 of them, okay? By having the majority of that gold, Roosevelt was able to create the dollar in 1933 by saying, okay, from this point forward, we're going to set up a brand new dollar backed by 8,900 tons, but we're going to raise the value of that gold from $7 to 35. The reason why the price rises to 35 is because at 7, in terms of the liabilities, it wasn't enough to cover liabilities. By rising it to $7 to $35, gold is able to rise, the asset side of the equation was able to rise to a higher level than the debts. So in essence, they didn't default on the debts. What they did is they devalued them by creating a brand new currency. Let's talk about that later. Let's concentrate on what happens with gold and the gold producers. Well, one of my speculation has been the fact that I've known this historical fact that Homestake Mining and Alaska Juno, through the depressions were paying out about 10 to 15% dividend yield. Reason being is that nobody could own gold, but you could own the shares. Now the shares prior to that reset, they're producing at $5 an ounce, but they're selling gold at 7. Once gold gets up to 35, they're still producing at 5. So the cash flow of the companies is flowing out an unbelievable rate, and they benefit by rising dividends. So the dividend of Homestake Mining through the depression for about 15 to 20 years, and Alaska Juno was averaging between 10 to 15%. They were the prime beneficiaries. Had you owned $7,000 worth of gold at the beginning of the depression, by the end of the depression, you walked away with $35,000. Had you had $7,000 worth of Alaska Juno and Homestake Mining by the end of the depression, you walked away with almost $80,000 and a 10 to 15% dividend for the life of the depression. My speculation has been all along that if history is going to repeat, I might as well build a portfolio of producers and take advantage of that historical fact, because again, this is the only way to reset the system. Now, some people are going to say, "Well, we're not in a gold standard anymore." Oddly enough, we've already gone through a fiat system. The last time that we by the way, a fiat system is a monetary system that is backed by the word of politicians. Now, that's enough to go there. The last time we messed around with such a system was in the 1770s, when the monetary control was under the French. Well, a guy called John Law was advising the French to just print money. Oddly enough, the second things the French did after cutting off the French king's head because of the economic mess left behind was to go and burn the printing presses. The British take advantage of the situation by setting up the gold standard. They knew that they had to go back to a gold-backed system, and the two guys that set up the gold standard was John Locke and Isaac Newton. They set up the gold standard that actually functioned for 200 years. Everybody says, well, gold will have to, we don't have enough gold, and all kinds of excuses. Well, for 4,000 years work, so my speculation is that it's going to work again. Let's talk about the currency reserve for a second. The currency reserve is the currency by which we do global trade. For 200 years, from 1770 to 1933, it was the British pound. In 1933, through gold, the power transfers to the dollar. My speculation is that the dollar needs to die because there's too many debts written in dollars. Whatever comes after, whatever is the next currency reserve, to me, it doesn't matter. What I'm interested is in the process of change. What happens as we go through this process and how the power shift occurs through gold. That is my speculation. And what I'm trying to show you is that wave has already started building. Can we go to the next chart? Let's look at this wave more from a monetary base. So this is the life of gold and the US dollar through this current currency reserve. Okay, 1933, gold spikes up from 7 to 35. Then again in 1963, gold starts to spike up because of the demand created by the blue line, by the way, is the monetary base of the central government of the Fed. This is the price of gold, okay? After the Second World War, the U.S. continues spending money, and here's the whole interaction into Korea, Vietnam. So they need to spend money. At the time, we were still working in a gold standard, so the price of gold kind of starts to escape, and forcing Nixon to unpeg at 35, where it had stood for quite a while. Because of all the rising debts. What was happening was that by the end of the Second World War, the Americans, at the beginning of the Second World War, they had 9,000 tons. By the end of the Second World War, they had 20,000 tons because they got paid for helping the Europeans with all of prior to them entering the Second World War with gold. So they started to accumulate a lot more gold. After the Second World War, because the dollar was convertible, the French and everybody starts taking back their gold. The French general and president is key in this because he's the one that kept calling the bluff of the Americans and asking to repatriate most of the gold. Once we get back down to 8,900 tons, Nixon says, okay, that's it, we're unpegging gold, we're setting up the new fiat system, and that's when gold starts its wonderful run up to $800, okay, which is right around here. But the monetary base continues building, right? And that's when until gold here around 2006 starts its next run, because central banks again are going through massive money printing. And this is 2008, that's the big spike that we see, and the money printing continues. Let's go to the next chart. Okay, this is more the last since about 2000, so this century, and what has happened with gold. Now here we're looking at the monetary base of all the central banks. Sorry, let me stop for a second on the currency reserve, because some people are going to say, yeah, the US dollar is going to be forever. I would highly disagree, and we just have to listen to what Mark Carney said at Jackson Hole last fall. He gave the last speech at Jackson Hole, and what did he say? He said the currency reserve is done. We need to recreate it, right? What he was really saying is the IMF, has to control that process. Funny, because in February, Trump was at Davos for the Davos conference, and he gave a speech and left right away. The media didn't report on the speech, but what did he say? Yes, the currency reserve is done, but you're not going to control it. The globalist system isn't going to be in charge of it. We are. So this game is afoot. So don't think that again, I'm looking at this as a chess game that's setting up. So the forces in front of us from a debt perspective require something to be done. So don't think that because it isn't mentioned, it isn't planned. In 1971, when Nixon unpegs, nobody knew, but if you had studied what was happening, you could have predicted. Same thing in 1933, and some people benefited. This is this century and what has been happening. Well, we have central banks that have been printing money like crazy, right? Now, in the year, so gold was fully correlated until about 2011, when we hit $1,900. Then it goes sideways, but then this decline occurs. Now, that decline, most people would say it's normal. I would say not, because what has happened, one of the things that I was doing at Gordon Capital, I was a repo trader. Again, the repo market has been in the news of late because it's in trouble. Now, repo, very quickly, what is it? It's at the basis of all credit derivative swaps. So futures and credit derivatives were my expertise when I started in the business. Now, what's interesting, though, is that this decline also coincides with a massive increase of paper shorts within the future contracts at the COMEX, okay? Whereby the best analogy I can give you is this, is that it's a game of musical chairs, where more and more people are coming into the game with paper contracts thinking that they have a piece of paper backing those chairs. But by the same token, through that period, the chairs have been taken away. So in this game, it's not that the music's going to stop, but that the chairs are going to run out. Because since 2008, the Chinese have actually transferred 20,000 tons of physical gold from Western vaults to China. First time I became aware of this when I was at Macquarie, because Macquarie has a big relationship with the Perth Mint. And since I was already a bit of a gold bug, chatting with somebody at the Perth Mint, they told me that, yeah, we've seen a lot of physical gold shifting to China because the Chinese work in a metric system. Now, being in a metric system, the ingots that were coming from the West had to be resmelted. And then they were being resmelted from the pound bars to kilo bars before they were shipped to China. Having known that, I started talking with Egon von Greyers out of Switzerland, and he also mentions that the Swiss refiners have been resmelting bars before they change them to China. So we know that the physical supply of gold has been leaving for China, which is an important piece of the puzzle, because the Chinese now control 20,000 tons of the now 34,000 tons circulating between all central banks. So that is the monetary base, which of if we were to work in a gold standard. Now, interesting is the fact that this price decline into 2016. Now, if you move to the next chart, please. Now, this wasn't in the one that compliance, but what I tried to do was, I couldn't find this chart extended to 2020, but I wanted to show what had happened since within the central banks. Well, The central bank money printing continued until they tried to come down here. It got up to $22 trillion until they tried to decline. And then we had this spike, and now we don't know where we're going to end up, but we've added more than 6 trillion now just in the last month and a half. And that is going to continue. Now, gold is still catching up in terms of where it should be. Keep in mind that a lot of this has to do with these paper, what we call the position of the commitment of trader report within the future contracts tracks that. And we can see that right now, for example, 8 traders control a huge amount of negative contracts. Having said that, it's important to note that we just had a contract rollover last Friday, and a lot of those contracts rolled over at about 1750. Well, the contracts that were rolling over would have been done at about 1300 to 1400. So there are massive losses that are piling up. So at some point, something's going to break within that mechanism. So that's why the gold trade, to me, has always been about patience in terms of, again, the longer it takes, the bigger the fiscal mess up, the higher gold will rise when it finally unpegs, because in my opinion, it is being manipulated in terms of the price. Let's move to the next chart. Okay, this is the history of the currency reserve and what I was talking about. The fact that the main currency by which we transact on a global basis has changed over time. This, to me, is the most important cycle because it's a cycle that repeats every 100 years or so, and this is when gold comes to the fore, because it is the monetary base by which we need to reset. The way to think about this is this. Think about all the condos that have been built all around us, right? We've already spent the resources, the real wealth, to build those condos, but we haven't paid for them. But yet the currencies by which those condos have been built in those debts are devaluing. Well, what is the true value of those things? Now, do the same analysis with a company like Boeing or any company that has been doing a lot of share buybacks. Boeing is indebted to the hilt, but beyond all that debt, there is real assets, real value in there. Right? So what is that real value? Well, in 1933, what needed to occur was that the value of the monetary base measured by gold needed to rise to a level to equate that asset, another way to look at it. That's an important fact, because whenever we go through these processes are done when gold and the Dow reach the same level. In the 80s, gold got up to 800. What was the value of the Dow? It got down to 800 in US dollars. In the 30s, 35 and 35. That's important to note, because if I'm correct and this is replaying, my speculation is that the Dow could go to 10,000 or 50,000 if the Fed is allowed to start printing money like crazy and take us into a hyperinflationary amount. It doesn't matter, because gold will get to the same level when the process is done. And that's why, to me, this is one of the ultimate mavericks in terms of the investment wave that we are riding. Whatever the next currency reserve, doesn't matter. What's important is the process that has already started. Next one. Now, what I wanted to show you and talk more about the portfolio, because the 2 stars, first of all, that's 2018 when I started tracking it. By the way, that chart I post every Friday night on my LinkedIn account in order to point out how much how that spread continues to, the divergence of those numbers continues to develop. And it has been growing, and I think it's going to continue growing. But the second star right here is 2015, when I set up my portfolio. Now, the portfolio is important to the composition of the portfolio. I want to just focus on a bit. First of all, I have 4 criteria for the portfolio. One was good management, good quality producers with low cost of production in geopolitically safe areas, and reserves on the ground. Reserves on the ground was key. When I set up my segregated portfolio, I call it the special opportunities, was in 2015, because I was covering for Scotia. For Scotiabank, I was the rep between Canada and Chile. I was covering all the big money that we have down there. And what I realized is that nobody had any gold, any precious metals. Everybody was dealing with an American or a European firm. and they all were diversified in the same way that everybody's invested. And I realized, well, if I'm really going to add any value added, why don't I set up a portfolio that these people can just plug in an allocation into precious metals. Okay, on the basis of that was the fact that producers, and again, producers still have quite a bit of room to go. Producers was where to set up. So the portfolio, the composition is solid quality producers within those 4 criteria. Next, I started adding royalty companies, which as well offer quite a bit of benefit. In 2018, I started adding projects that had become dormant. Same thing, QMX, for example. Sorry, I shouldn't be talking about stocks, but projects that had become dormant that are going to get restarted because everything's starting to kick in now. And just of late, I've started to add 2 exploration plays within the portfolio, and that's it. I think that the most important thing for people starting to build positions within this is, first of all, to take a serious allocation within the sector as a percentage of your investable assets. In 2015, I kept saying, okay, you got to have at least 10%. 10% because if we look at Ibbotson, 8% is the minimum that they recommend as an asset allocation for your investable assets. By 2018, that had risen up to 20%. Today, I'm at 30%. Now, why is that important? Because we've just gone through a massive level of turmoil. My equity income portfolio, another portfolio that I manage, which is more diversified to generate cash flow, that portfolio right now is sitting in 30% in precious metals, 30% in cash, and 40% invested only. Well, that portfolio took the hit, but it's fully rebounded. Having 30% has allowed to have enough of a hedge. In March of during the decline that we just went through, I was interviewed, and then somebody said, "Well, why didn't you lock in any profits within your precious metals holdings?" My answer was that, why would I do that when, to me, these companies are the lifeboats? It's my seat on the lifeboat of the Titanic. So why would I sell at the same time that the ship starts to go down, right? And that, to me, is the best analogy that I can give you. Now, what I've noticed is advisors are starting to add to their positions. Well, having 100 shares of Barrick or 25,000 shares, $25,000 worth of Barrick and $25,000 worth of Goldcorp won't be enough. It's like having a toothpick for a life preserver as the Titanic starts to go down. So again, asset allocation is going to be important, and this trade has already started. If one last thing was that in 2015, when we set this up, gold was hit a low of about 1,050, and the HUI was at 107. It just crossed, just nearing 300, which means that it's up about 180. Gold itself is up 80%. The portfolio since 2015, the model that we track, is up substantially more than that. So the proper stock picking is working. Another thing within that, I have no ETF. I have no GLD, because one of the problems I have with ETFs is the fact that they're all established with futures. The problem in the system is the futures market, right? And I think if I don't own it and I can't touch it, I'd rather not touch it, right? One of the problems with futures and anything that's driven by futures is the fact that you're assuming counterparty risk. In 2008, once Lehman went bust, the counterparty risk came, it was important, but because the Fed was able to bail out the system, it doesn't really matter. I don't think this time around it's not going to matter. I think this time you got to own it. It's got to be held. Next slide. This is an important quote. Jesse Livermore, I don't know if many of you know him, but he was the best trader of the 20s. In 1929, he actually made $150 million in then dollars playing the crash. But this quote is, to me, just encapsulates the portfolio. It was never my thinking that made me big money for me. It was my sitting. Got that sitting tight. Buy right and sit tight. And that's what I've tried to do with the portfolio in terms of looking at it as a hedge for all of the volatility that is coming that is coming our way because of that. This is being driven by all of these derivatives. One last thing I would like to say is the fact that don't confuse COVID-19 with this financial mess that was already started. The repo market in 2008 gave one of the reasons why first time I was on BNN, I actually said that I was preparing in January of 2008 for a very tough 2008. I actually called it. And the reason was that I saw the repo market starting to give the signals. Very quickly, what is the repo market? Repo trades is me being Gordon Capital borrowing money from JP Morgan. Okay, now we can borrow from the Fed at that point. So in 2008, we were borrowing at 4%. All of a sudden, the rates jumped so we lent to each other at 4.25, only 25 basis points, very short-term rates. All of a sudden, the rates jumped to 6%. So a 50% loss of trust between us. That to me was a clear signal that something was happening within the system. In the fall of last year, the rates went from 2 to 10%. That should give you pause because it's not a 50% increase in loss of trust. It was a 500% increase in loss of trust. Another check mark in that my speculation that gold is going to be very important because of debts kicked in. Jordan, next slide, please. Oh, of course, the whole funny writing. That's it for my presentation. I want to play one last clip, and this is from 2017. This is the head of the COMEX, Terry Duffy, talking about gold and where it should be at that point.
But we haven't seen it into the metals. We haven't seen this if you're concerned about, for example, global crises. And we see a little bit when we see a dust up with the North Koreans or all of it. There's a brief run up, then it runs down. But what do you think's going on there, or beneath the scene? Is there something that we're missing?
Well, I think that's really interesting that, Neil, what you raised, especially with the metals, because if you look at the price of gold today, just around $1,200 an ounce, and if you look at back in the early 80s, it was trading around $800 an ounce. So if you adjust for inflation, you should have gold somewhere around $2,000 to $3,000 an ounce, but we don't. And then you look at what's gone on in the world, and it should probably be at $5,000 or $6,000 an ounce, but it's not. So the reason is, I think a lot of us have become so jaded, and whatever happens in the world, it's like yesterday's newspaper in 5 minutes. So people are dismissing some of these events to a point where one day you won't be able to dismiss them, and you'll see a huge move in some of these precious metals and other products.
5 to 6,000. I think what he's talking about, more importantly, was the fact that it's at the COMEX that this game of musical chairs is being played. Let's open it up for questions.
Perfect. Thank you so much, Jamie. So yes, those of you who would like to ask some questions, we have some that have come in already, but there is a Q&A section to this webinar. So feel free to ask your questions in there, and we'll do our best to answer as many as we can. So Jamie, I have a couple here coming for you. What indicators will you be using to know that your assets have reached their maximum value?
One more thing before I answer that question. That portfolio is all precious, is 90% precious metals, 92% precious metals, and blockchain. I love blockchain because I see it as the modern, whatever monetary system we set up going forward, blockchain would offer us a way of moving through in a decentralized system where we won't need the banking system. So to me, that's a very big positive. What indicators? Well, I expect the price to continue rising. First of all, I think demand right now, we're just starting to see a trickle coming in. So I think the producers will start to move. There was a really good, there was a snippet today from John Hathaway, who's joined Sprott, where he's saying, the interest right now from institutions still into physical, they're not coming into the companies just yet. So I do expect that a lot of money will eventually start to move. So there is the patience to acquire. The fact that nobody owns it, to me, offers quite a bit of safety within the trade, in that you can still start to acquire. How high will it go? That is a funny answer, because if we do reset the monetary system, gold will reach a point, a high, which it will not come out. It never went down after it reached 35. It never came down, after that point, once the monetary system was reset. If that occurs, we might not come down. The other thing that I'm noticing is that the dividends are increasing. So that cash flow theory is actually playing out. You know, Kirkland Lake has a dividend. It didn't have a dividend 5 years ago. Agnico just raised its dividend. Franco-Nevada just raised its dividend. So did Newmont, 30%. So all of the producers are starting to raise dividends. So everything's playing out. I think we have time to wait. Right now, it's about positioning and getting in. You know, once I start to see that pension fund start, the first pension fund that I saw coming in was Omers, I think it was, where they did a 500 million placement into Alamos Gold, I think it was. But that was just about 2 or 3 months ago. So for now, I think we're just playing catch up. Same thing with silver. Silver's finally starting to move. I think once we get about 30, 40, once we break the 2019 highs, you know, I think of it like a slingy. The companies are just catching up to where the HUI should be to price in $1,700 gold. And by the way, gold in Canadian dollars is at 2,500. Let's not forget that. It's at 2,480, right? In 2019, gold was at 1,900 with the US dollar because the dollar was at par. So it's a really good indicator of what's happening to the Canadian dollar. So again, I think the way I see it is the wave is building. I'm just riding it, and each one of my positions is just another quiver, another one of my surfboard to surf that wave, but I'm not ready to get off yet, and I think we're way from that.
Great. Another one coming in here is, what do you own, Jamie, in regards to both gold and silver stocks?
I can't talk about positions right now, but I'm very happy to share that if anybody wants to contact me through email, only because we're in the process of moving the portfolio. So I can't talk about positions right now. I'm restricted, but within 2 weeks we'll be fully re-changed. What do we own though? We own good quality producers. The 4 criteria: good management, reserves on the ground. Reserves on the ground are going to be key because right now they're priced at 0. In 2011, reserves on the ground were pricing in at about $70 an ounce. At the high, they almost hit 100. Well, think about Agnico Eagle with 20 million ounces. What's going to happen is that the musical chairs have been taken away. What's going to happen one day is that you're going to have all of these guys standing with a piece of paper wanting to buy gold, while the reserves on the ground are going to have a lot of value. So producers in geopolitically safe places, we're starting to see those issues already. With low cost of production. Next come the royalty companies. I think royalty companies, well-managed ones, are very important. The asset allocation gold to silver is tracking about 40% silver right now, 60% gold. I look at physical gold as cash. So in my equity income portfolio, I'm sitting in cash. That's going to be allocated to gold and silver, physical, instead of just sitting in cash, because I think I'm going to be sitting in cash for a while. After that, I started adding, like I said, companies that went dormant that are getting restarted, and there's a number of those. And lastly, I've just started to add exploration plays. There's only 2 in the portfolio. Outside of the portfolio, I also recommend flow through for people. I do buy flow through for clients, and I've been buying more smaller plays that are coming around that are being brought to us from Canaccord, from the institution. I would say build that before you start looking at the exploration. Again, it's a lot of fun to have exploration plays because there's good money to be made, good speculation. But there's a lot of safety in owning good quality producers right now, which I think are going to be the prime beneficiaries going forward as a hedge for your other assets.
Perfect. Thank you so much, Jamie. I think that's all the time we have today for Q&A, as we've gone pretty close to the hour here. So thank you so much for the presentation. We really appreciate you coming on and sharing your expertise with us.
Thank you very much. Thanks for having me.